Hi guys, I thought I'll go through this again. I tried to go through this last night, but the camera work wasn't the best, and I realized when I was reviewing the recording, so I decided to do it again because this is really important. And even if you don't fully understand it, hopefully this background will help you apply those, apply to calculations, and eventually will click, hopefully. Now, so what yesterday or last night, what I was trying to do, which wasn't captured very well, was to explain the logic behind the cash flow statement. Obviously, it's cash flows, so now we're strictly looking at cash inflows and outflows. Nothing else. So if the transaction doesn't involve any cash, then it won't be captured in cash flows. However, in balance sheet or income statement, they are prepared on an accrual basis, meaning we recognize transactions as they incur or occur. So it will be captured there, but cash flows is strictly looking at cash inflows and outflows, and that's it. What that means to us is that when we look at sales, that will be from the income statement, and that can be made from cash sales or credit sales. If it was on credit sales, then we will have accounts receivable. So we can get that from income statement. We can get that from balance sheet. When I say cash here, it's cash sales. Now, this is not shown on the balance sheet separately. You will have a cash balance, but it does not necessarily means that it's cash from sales, right? Because it could be cash received from non-current assets, or it could be cash from capital. So now your job is to work out that amount so we can include it there. Now, so yeah, what I was trying to do in the previous recording is that if sales would say $15, and we know the accounts receivable has gone up by $5, for example, then can we work out cash sales? Yes, we can, because cash sales could come from sales could come from cash sales or credit sales. So if the credit sales were $5, then cash sales must be $10, right? So that means from sales, we exclude the increase in accounts receivable, take that away, then it will give us cash sales, and that's what we will include there. Cash sales meaning that from sales, how much money did they actually receive? So how to calculate cash sales is sales, and then we'll exclude the increase. Will increase in accounts receivable or credit sales. How we do that is the difference between opening accounts receivables and ending balance of accounts receivables. So we add opening balance of accounts receivable and take away closing balance of accounts receivable. And that's how we apply or adjust for credit sales to sales. And if there were any bad debts or doubtful debts, we'll exclude that, because doubtful debts meaning that whatever credit sales they made, they're not going to receive by that much. So it will reduce the cash receipts. And we also exclude discount allowed, because if they gave discount to their customers, that means they are not receiving that much money, cash, because we're looking at cash receipts. This bit is the most important part. I think those two are quite understandable, because I mean, if you're not going to receive money from your customers, then of course cash receipts will go down. If you gave discount to your customers, then you receive less. So that's why we exclude. But to explain this, so if I draw a timeline, let's say that this is a previous year, and that's the current year, and that's the future period. And we are looking at the current period. And that's the 1st of July, and that's 30th of June. If we have opening balance of accounts receivable, that means this is coming from previous period because that's the opening balance, right? Current year's opening balance is the ending balance from previous period. So what that means, previously, they must have recognized accounts receivable and then credit sales. So when they made sales in previous period, they didn't receive money, so they create accounts receivable. That's what opening balance means, because once again, opening balance in the current period is the ending balance from previous period, right? So the sales must have occurred in the previous period. But then, because they didn't receive money then, when are they going to receive the money? In this money will be received in the current period because this is a current asset. So they receive the money then. That's why we have to add opening balance of accounts receivable. Now, then ending balance of accounts receivable or closing balance of accounts receivable represent that as of 30th of June, they still hadn't received the money yet, or hadn't received money. They made the sales, so this one would be when they made sales in the current period, they would have done this, but that belongs to the current period. Then now, this accounts receivable or that will be received in the future period. That's why we need to exclude closing balance of accounts receivable because it's not received in the current period. So it will be received in the future period, but the sales are included already in the current period. So we need to exclude the closing balance of accounts receivable and add the opening balance of accounts receivable. So to explain that again, opening balance of accounts receivable is created from last accounting period, but it will be received in this current period. That's why we're adding in. Ending balance or closing balance of accounts receivable means the sales were made during this year, but it's not received in the current period, but it will be received in the future period. Therefore, we have to take that away from the cash receipt because we didn't receive it. Then we reduce the cash receipt by doubtful debts expense, if there were any, and then we reduce it by discount allowed because that means we're not going to receive by that much. When I said accounts receivable here, it's the net amount, but sometimes there is no difference because that means they don't have allowance for doubtful debts. If they did, net amount of accounts receivable net accounts receivable means accounts receivable less allowance for doubtful debts. That's the net amount. Yeah. Sometimes we don't have this, so that is all you have. But if you have allowance for doubtful debts, then we use the net amount of accounts receivable. Just be aware. Cool. I hope this makes sense. If not, please ask me. This is very, very important. Yeah. So that's how we calculate. In the exam, you can use a T account, but because we're using Excel, I think this will be faster by doing this. And obviously, there are so many formulas if you want to memorize it. So I try to explain it so you can actually understand it. And the next recording, I'll go through cash payments.